Hi guys, this is Dr. Sadasivam once again with you, and today in this post we are going to talk about the relationship between bonds, interest rates and the stock market. What is the interrelationship between these factors and what we should keep in mind when we make investments in the stock market? That's what we're going to see. If you remember, there was talks about the Federal Reserve increasing its interest rates last week. They have not increased. The official circulars have not been released, but Jerome Powell just pointed out that they might consider increasing the interest rates well before the expected time or the pre-planned time. This statement was enough to create big tremors in the stock markets throughout the world, and we also saw the Nifty index falling down considerably. We have discussed the statistics in one more video in detail. The Nasdaq went down. And normally what happens is when the bond yields start increasing, the money will go out to the from the emerging economies, because nobody wants to pay huge interests when the interest is going. So there is a big shift of capital from the stock markets in terms of servicing their existing debts. That probably explains why the stock market goes down under such situations. It happened last week also. One specific day the stock market fell, right? I'm talking about Nifty. Why did it fall? If you look at the reasons, the bond market in the United States went up. So when the interest rates go up, the money starts going back from the emerging markets to service their existing debts. This is what is the relationship. We all remember what happened during the March of 2020, and we also know what happened in 2007, right? Subprime crisis in the United States. In such times, what happens is people do not want to spend. Money has various functions: primary functions, secondary functions. We have all studied basic economic trade. It's a store of value, it's a medium of exchange. All that is theory. I don't want to get into theory at this point of time. But all said and done, whenever there is an economic downturn, people do not want to spend. Now the question is, if everybody starts saving money and nobody is willing to spend, then what happens? The business will go down, because unless you spend, unless you consume, there won't be any consumption. Because if consumption does not happen, production does not happen. If production does not happen, then there will be job losses. Companies will not expand their capacities. They might cut down their capacities. When they cut down capacities, they need less manpower. Less manpower means they may retrench manpower. Employees may remain without salaries, and you get into kind of a vicious circle. So generally, what the government does, the government generally does certain things which are called as instruments of credit control. They have a lever in their hands and they start operating that lever through Reserve Bank of India. How do they do that? They will reduce the interest rates. So when you reduce the interest rates, what happens is the cost of doing business goes down. So when the cost of doing business goes down, the industries will start producing more and more. They will start producing more and more. There is a very important law in economics which is called as Say's laws. I discussed about Say's law in one of my videos earlier. You can go through that, and that was, I think, a video on rich getting richer and poor getting poorer, in which I talked a lot about Lorentz curve. I talked about Gini's index, the gap between the rich and the poor people. In that, I have completely explained these concepts. So the cost of doing business will go down, and when you start producing more and more, the supply will be more. So the corporate companies will introduce lots and lots of push and pull strategies, marketing strategies. You might have seen a lot of advertisements where discounts are being announced, a lot of subventions are being announced by finance companies, 0% interest. So from both the sides, there will be push factors, there will be pull factors. Then the corporates will do all this just to spruce up the consumption, right? Just to increase their sales. So when the corporates do that, the government will do its part by reducing their interest rates, repo rates typically. So the government is putting money in the hands of people. Your stimulus package of $1 trillion announced in the United States, some schemes that government of India had announced, all that is to put money in the hands of people. Now what happens on the demand side? Now we've talked about the supply side. Now the customers have less incentive to put that money in the bank because interest rates are down, right? So no customer wants to put money in a bank for low interest. Instead, they would like to buy cars, they would like to buy refrigerators. Even the government, if you remember, they announced a scheme to spruce up the consumption. The government said the government employees can use their LTC money to buy white goods. Why did the government do that? Because of the multiplier effects that it creates. Multiplier in the sense, instead of using it on LTC, you use it to buy white goods, right? So probably some kind of a expansion will take place. Companies will employ more and more people. So these are some of the reasons why the government did that. Investment in infrastructure. I've put one more special video on all this, including investment in the infrastructure. So you can go through those videos. You can find that in the link. That will give you a very clear picture of how inflation, investment in the infrastructure, all that will lead to virtuous cycle in the economy. Now on the demand side, we've already discussed that when the customers have less incentive to keep that money in the bank, they start spending, and this spruces up the consumption. Now, if you remember, in the year 2007, when Lehman Brothers collapsed, the interest rates in US literally went down to zero. Even during coronavirus, I'm talking about March 2020 last year, the interest rates virtually went down to zero. In the United States, I'm not talking about our country. Of course, our country also interest rates went down. So when one bad phase is over and the economy starts doing well, which is what is happening in US, all those indicators are doing extremely well. You know, if you look at US, they're not as much affected by the second wave as we are, especially India. Their indicators are doing extremely well. Now US is thinking of increasing their interest rates because these are emergency kind of contingency measures. They will not continue forever. As we discussed, there is a direct relationship between your growth imperatives and your inflation imperatives, because they always go in cross directions. If you want growth, then you have to compromise on inflation. If you want inflation, control inflation, growth needs to be, because too much money, if it is chasing too few goods, then obviously there will be inflation. That becomes inevitable, right? Even in inflation, you have so many kinds. Some inflation is cost push inflation, demand pull inflation. I've explained all this in detail in some other video. The same thing I think we discussed in rich getting richer and poor getting poorer. We have discussed all these theories. I request you to watch those videos to get an understanding. So when the economy is doing well, any government would like to take off the crutches, because somebody had a leg injury and they were using the crutches. You cannot keep the crutches throughout your life, right? Same thing happens in the economy also. When the economy starts picking up, obviously this liquidity needs to be taken back. Otherwise, controlling inflation will be a big issue. Certain things happened in Zimbabwe. Runaway inflation, 4 lakh percentage. It happened in Venezuela. It happened in Germany, guys. Runaway inflation. It was called one of the most advanced. They had a runaway inflation. Germany, right? Because somewhere the government did not manage the instruments of credit control properly, probably. That explains why even countries like Germany had inflation. Now, going back to the Indian markets, if you remember the years between 2003 and 2007, it was a fantastic year for the Indian stock market, bull run. In fact, the SENSEX went up from 3,000, I guess, in 2003 to 21,000. SENSEX, I'm talking about SENSEX. 2003 it was 3,000, and in 2007 it was 21,000, which is 7 times 600%. I was in Muscat at that time. I couldn't get the benefit out of it, right? Interest also went up, but in spite of that, the stock market went on going up. Bull run. It defied all economic theories at that particular point of time. If you remember those days, RBI's policy used to be once in 6 months, right? 6 months, once in 6 months. So we are talking about these instruments of credit control where the government uses these levers in terms of changing the interest rate. Typically your repo rate and reverse repo rates to control the supply of money in the system. You have like M0, M1, M2, M3. I'll be putting up a separate video on that. That typically shows how much money is circulating in the system. We're talking about M1 money supply now. So using these levers of credit control, the RBI controls the amount of money supply in the economy, thereby balancing between your growth objectives and the inflation objectives. It's an acrobatic walk which requires high level of judiciousness, tact and skill to walk that path. So those days the RBI policy used to be once in 6 months. Now it is considering all these factors, it's being done once in 2 months. Remember, I put one video in the month of April on that, first week of April. After the MPC gave its recommendations. One more video I put during the first week of June, because there was a meeting of MPC from 2nd to 4th. If you remember, that video was in Hindi, right? MPC committee is Monetary Policy Committee, separate video giving all the recommendations of the MPC committee, both in English as well as Hindi. Please go through that, which will help you understand these concepts a little better. Because as far as these concepts are concerned, if you listen to it once, you will not understand it completely. But the more you start listening to more and more videos, your ideas will start getting crystallized, and over a period of time you will understand interest rates, bond, stock markets, repo rate, reverse repo. It's something like your call and put options, right? Your call options, put options, strategies, your swaps, your short straddle, long straddle. As you play the game, start playing the game, you start understanding what is what. So we also have these 10-year bonds, the government's treasury bonds, commercial papers, GSEC, GSAP, all these things. I will be putting up separate videos. I don't want to use all that in this particular video, and I don't want to confuse you, because all these factors are working towards the same objective, right? Okay guys, I think you enjoyed this video. We talked about bonds, interest rates, stock market. We also looked at various instruments of credit control that the government has and how they pull the levers. Guys, I hope you enjoyed this. And this is Dr. Sadasivam signing off till we meet again in a different video. Jai Hind, bye bye.